Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And good day to you. Rick Durkee here on Navigating Retirement and another edition of our podcast show. And today I want to talk a little bit about luck versus planning. Hey, we're coming up on St. Paddy's Day, the luck of the Irish. And Wednesday, March 17th, we'll be looking at another St. Paddy's Day. So to all you Irish and all the people that are wearing green on St. Paddy's Day so you don't get pinched, let's talk a little bit about today, luck versus preparation. Now, I had a saying once taught to me that said, luck is the meeting of preparation with opportunity. It's a great way for us to think about how we could be lucky. Remember, if we have a plan, when we're talking about planning or financial planning, that's a way to be prepared. And when we know what opportunity we're seeking, we can find those opportunities when we're better aware of them. So that will make us lucky. It'll be the meeting of luck and preparation. So let's talk a little bit about how luck does actually favor the well-prepared. So here's an analogy. You don't expect to eat one salad or go to the gym one time to be in great shape, but you eat right and you exercise your whole life. And then in your later years, you may say to yourself, I was lucky to remain healthy. And you'd be right. That was a plan and that was preparation. And you went through your life and you ended up in good shape, good financial and health shape in your retirement years. In our financial life, having that discipline, doing the work, and having good routines and being well prepared has many benefits that extend to you beyond just being lucky. So, what areas do you see preparation being superior to luck? Can you think of any situations where luck didn't lead to success? How about that lottery winner? Most of them go broke within 5 years after receiving that money. It hasn't been incorporated in them how to plan for what to do when they have that money because they received it, they got it in a lump sum or they got some payments and then all of a sudden it went away. What steps could we do to better prepare for our financial success, especially as we work into our retirement years? Now, timing the market and timing retirement. Both two critical key issues. When we say timing the market, we really should be looking at not timing the market. It's time in the market that makes us successful investors. Some say timing is everything. I bought that stock at its low and I sold it at its high. But every investor knows you can't time the market, right? Timing the market is difficult to do. Many of us have thought that we're experts at timing the market because we picked that stock. We were lucky. We were in the right place at the right time. Actually, investing over time will create that opportunity that we'll call luck in the investment markets. Asset allocation now aims to diversify your funds. The theory goes that when stocks rise, bonds will fall. Timing the market and timing retirement are certainly two critical things that we should think about as we're doing our investing. Some say timing is everything. I say time in the market is everything, not trying to time the market. It's actually a way for us to at least see our retirement funds grow when we have a long time horizon and we can allow those assets to go up and down and hopefully provide us with some higher returns. Now, asset allocation aims to diversify your funds, but the problem is that we found out too painfully in 2008 when all asset classes lost that that's not always true. So some people weren't lucky when they planned on asset allocation to diversify their portfolios. Problem is that we need to make sure that we have a plan. A plan based on luck is not a plan. A plan based on speculation is not a plan. So let's have a plan not based on luck or speculation. Let's have a plan that addresses retirement's greatest risks, providing an income that can't be outlived and can potentially offset inflation. We've talked about this one in many different shows before on navigating retirement over the years. It's called income allocation. Income allocation is not a plan of luck. It's a retirement plan. Income allocation creates predictable, measurable, and sustainable income streams that won't fluctuate and will last throughout your retirement. Income allocation addresses the key risks of retirement planning, longevity risk, or the possibility of outliving your money. It also addresses major stock market corrections in a way that asset allocation can't. So ask yourself this simple question: do you really want to leave your retirement plan subject to the risks of market timing? Let's talk a little bit about finding that pot of gold, and that's not really a retirement plan. So here's 7 financial myths that you might want to pay attention to here. Number 1, market always goes up. We know market doesn't always go up, it goes down too. Number 2, the 10% average market return. I don't know anybody that's ever had a 10% average every single year. Okay, markets do average out higher than our bank savings, but we need to make sure that we realize that markets go up and markets go down. Number 3, 4% retirement cash flow, withdrawal rate. Remember withdrawal rate risk from previous shows? 4% retirement cash flow may not be your individual need when it comes to how much money should I take out. Number 4, taxes will be lower in retirement. I don't know about you, but I'm thinking taxes are going to go up. And they're going to go up soon. And I also know that my IRA is fully taxable. And I also know that the IRS regulates what I'm going to pay on taxes over my retirement years. Number 5, I don't need life insurance once I retire. Well, maybe life insurance might be a way that you can pass on an estate to your loved ones, income tax free. Number 6, I can rely on my investment plan for retirement. Now, that means that you're going to subject all of your risk in the market, that the market's going to continually go up. I don't think that's a very good plan. I think we're going to be hoping for that to be something that happens. Number 7, it's too late to plan. I don't have enough. It's never too late to plan. You have built a certain amount of retirement assets. I think that everyone should take that and look at what all your possible resources are. There's many other ways we can generate income in retirement. And so let's get together. Let's put that plan together. Let's see what your options are. Hey, it's been fun today talking about myths, talking about St. Paddy's Day, the luck of the Irish today. And we look forward to having you back in another edition of Navigating Retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospect will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.